Here we are on another Tuesday at our Wise Guru Q&A, and got a couple of good questions from our global Australian expat audience today. One of them is from a client in Hong Kong, Nick, who has been following us for quite a long time, since earlier this year, and been attending some of our updates and Q&As, and he is particularly interested in property in the Gold Coast because he already has some property there and likes that area. So next question was, property prices have already moved. I was considering either a neutrally or positively geared investment play. Is it still feasible? And considering what's happened to coastal real estate prices, is that still an option that I can consider? So let's break that up and let's think it through, because there are quite a lot of other little sub-questions contained in this thing. Starting from the beginning, I suppose, we correctly envisaged that property prices would perhaps come down by 5 to 10% in Sydney and Melbourne, and then look to move upwards. That hasn't actually come to pass. The move down was less, and the move forward has probably caught most economists, certainly most of the economists at the major banks in Australia, by surprise. But let's look at what that really then pans out, and how this could impact someone, and how this question could be answered more fully. Because the reality is, if you were looking at buying into an area such as the Gold Coast 6 months ago, why would things have changed now? The simple fact that prices have gone up shouldn't deter you from your first off fundamental reasons for buying there, especially if it's for investment. So we've looked at the different property markets around Australia, as we have done for many, many years, and we've come to the realization a couple of years ago that we think most people are going to get the best bang for their buck in southeast Queensland. There are numerous reasons for that, and we don't have time to go through that today, but I'll sort of, I guess, touch on some of the major topics. And if we look at that, they have always been the easiest pie: population growth, infrastructure growth, and employment growth. And if we look at what's happening in this world of COVID, international migration has ceased. International tourists have stopped coming to Australia at this point in time, even though a plane load of 63 actually landed today in Darwin. So a minor breakthrough there, but it's not going to impact the numbers. So we looked at interstate migration, and Queensland's had the highest rate of interstate migration last year in a decade, and the year before that also, and we see that continuing. In fact, the amount of people moving into the state from other states is greater than last year's arrival numbers from overseas. So that's a pretty positive impact for the region, and a lot of those people are obviously moving to Brisbane and southeast Queensland, being the sort of economic hubs of the state. So that's important. The population growth will continue. The infrastructure growth is an important thing to consider, because it not only creates employment, but then creates far more in terms of efficiencies going forward. And currently there are infrastructure projects on the Gold Coast that are underway to the value of around $25 billion. Now, that's transport infrastructure, like the light rail that's going from Broadbeach down to Burleigh, and later on may go on to the airport. It's a bit of a game changer for the region. There's a massive technology, healthcare and knowledge park being built over $5 billion. There are a lot of major projects that are underway, including the airport, which is undergoing a $500 billion upgrade. So all of those things are things that we look at, because they're going to add value, I think, to people who are buying quality assets in those regions in the next decade to come at least. So they're the things that are happening. And if you look at that, the employment that creates and the ability for people to commute far more seamlessly is really going to be a bit of a game changer. That's all outside of what's happening at the moment with COVID, work from home, like this, digital meetings, Zoom meetings anywhere around the world. There are people watching this from wherever around the globe, and that makes I guess, the coastal regions, especially in Queensland, a fairly attractive sort of proposition for many people. We have people in Sydney who are saying, look, I think we might look at buying something on either the Gold Coast or the Sunshine Coast because we can work from home and we think we'll be able to, at least for some days a week in the longer term future. So that may be a good outcome for us. We wanted to live in Sydney before, but now we might want to live in the Gold Coast and turn our Sydney property into an investment property. So if you look at those macros, I mean, they're pretty important. They're going to be going on a long time. And it then makes you realize that if the price has gone up a small portion now, it's not something that's going to be hugely relevant. But it is relevant, I guess, from a human nature viewpoint, because people that were waiting were sort of sitting on the sidelines saying, look, I'm sitting there like a vulture waiting for these distressed property sales, asset sales to come to pass. And we said that's not really going to happen because the government stimulus measures were fairly swiftly implemented, highly targeted, and have done their job well. So what we're seeing now is that the banks have said we see up to 20% growth over the next couple of years, 2 to 3 years in Brisbane and surrounds. And we see also strong growth for other property markets around Australia, Adelaide, Perth, Canberra, showing that already. Sydney and Melbourne obviously lagging behind to some extent, but again, coming out of a situation where it was a massive lockdown, for example, in Melbourne, and really rebounding pretty rapidly. Overall, it's a positive story. Then let's look at what else has happened. The RBA have come along and cut rates to an all-time low, 0.1% cash rate. They've come out with their own form of QE, targeting 5 and 10-year bonds. They're saying that they're going to control the short end of the yield curve and keep 3-year bond rates at 0.1%. So all of this means that we as retail borrowers can go out and borrow money more cheaply from the banks. So that is going to create more impetus for property prices to move up. And I'm speaking here on a general basis around Australia. So all of that upward pressure means that if you haven't bought something and you wanted to now, you should really consider that, because I think that this will continue over the course of 2021. I think property prices will continue to move up. I think the rebound is in its infancy at this point in time in most markets. And we're noticing a lot of our clients, because we do our own research, who are looking for houses to live in Sydney, Melbourne and Brisbane and the main, are finding it very difficult because stock levels are still fairly constrained. So not enough stock, lots of buyers, pent-up demand, inexpensive access to loan funds. All of that means that they're positive drivers for property prices over the next year and ensuing probably 2 to 3 years at least. So the answer to the question is a lot, I guess, more difficult than simply yes or no. And you have to contemplate what else is at play. So if we look at the other options or the other impacts that you have there, the valuation gap is still a very compelling argument between, say, Sydney, Melbourne and Brisbane and surrounds. So if you look at Sydney and the North Coast and the Illawarra, Melbourne and say the Mornington Peninsula or Geelong, and Brisbane and Sunshine Coast or Gold Coast, there is still a massive valuation gap between New South Wales, Victoria and Queensland. That's going to continue, but I think it will probably compress over time. And we're seeing some of that now. So let's have a look at what happens. The latest numbers that came out just today from CoreLogic on their hedonic house value index has shown us that over the last month, so November, overall housing prices went up 0.8% around Australia, but that was made up of a 0.7% increase in the combined capitals and a 1.4% increase in combined regional centres. And the Gold Coast is now the 6th largest regional centre in Australia, so behind 5 of the major state capitals. Something worth bearing in mind, Nick, I hope that sort of, gets to the crux of some of this. we have some other sort of interesting means perhaps of entering the market and even benefiting from perhaps a delayed entry. In other words, you're wanting to buy something there, you realize you probably should have done that 6 months ago, but don't wait another 6 months is what I'm saying if you're intent on doing that, because we're seeing a lot of our clients who are looking for places to buy, first home buyers, some of them, who are simply saying, look, we understand what's happening, we can actually borrow more money because we can afford to, and they're entering the market and actually purchasing things. So with limited stock coming up, and it will quieten down over Christmas and January, as normally happens on a seasonal basis, I think it presents some pretty good opportunities for people who have got their funding in place, have a formal pre-approval from their bank, and are able to make an offer that's going to be very palatable to a would-be vendor. Okay, now, pardon me, the second question is from Eric, and he has said to me, look, I've bought a property, it doesn't settle for another 6 months, and obviously I'm an Australian expat, so I'm not earning in Australian dollars. Should I be transferring my funds to Australia now, or should I wait then? I actually think that, these are his words, the Aussie dollar is going to come down, so I think I should wait. Well, you know, no one has a crystal ball, and I'm certainly not a Forex trader, but I look at it on this basis. Given the fact that it is very difficult to pick currency fluctuations, especially between currency pairs at any time. Now, when we've had the result from the US election come into play, you know, the situation where we're going to have a Republican Senate and a Democratic House, there are lots of pressures, I suppose, that one could say are building on the US dollar. And the flip side of that is that I actually, from a personal viewpoint, am reasonably bullish on the Australian dollar. The Aussie dollar moves in generally sort of 2 to 4 year cycles, and I think it bottomed out in March. So I actually listened to Bill Evans at Westpac. I've known him for a very long time, and I think he's a really good reader of markets. And his idea or his insight is that he feels that the $8 will finish this year, 2020, at around 75 cents to the US dollar, and next year at around 80 cents. It's probably well on track to that. It's currently trading just under 74 cents to the US dollar. So if we look at that on a holistic basis, how do we then look at this question? What do I do? And the fact of the matter is, because none of us know, so we could just be a gambler and say we could transfer all the money now, or we could wait 6 months and transfer all the money then. But I like to think that perhaps, you know, because you don't know what's going to happen, a more prudent approach could also be useful. So in other words, you could perhaps look at transferring half now and half then, or a third now, a third in a couple of months, and a third then. Pick anything that I guess suits both your risk profile, what you're trying to achieve, but recognize that it's probably only going to be after the event. So after 6 months elapse, that in hindsight, you might say, well, that was the best day or best week to transfer my funds, and that's not going to happen. So why not be a little bit more conservative, if you like, and do it on that basis? So that's a short answer to the question, but let's look at it from a more holistic viewpoint. The fact is that generally speaking, and in this instance certainly the case, the person's already paid their 10% deposit some time ago. When they come to settle in 6 months, they only have to pay another 5 or 10%, depending on whether they have an 85% LVR loan or an 80% LVR loan. So the amount of money that you're going to transfer is insignificant when you consider 100% of the purchase price. So that's worth bearing in mind, so you don't waste too much time trying to finesse that currency exchange move. The second thing, of course, is that, hey, you know, it's a great problem to have, isn't it? You've got an asset, 100% of that value has been growing for you and will continue to grow for you, I believe, at least over the next 6 months. and you're simply having to worry about how to best extract the last bit of value from that currency exchange. The reality is it won't really matter. You're already on a very good situation where the return on your own funds is going to look pretty attractive from an IRR viewpoint, given that not much money has actually been expended in terms of your own cash. So if we look at all of that, I think it's not really, we're not talking here about currency speculation. It's more of just a timing issue. When do you do this? And so therefore, don't get bogged down in that. I think, the best thing is your whole asset is appreciating and doing the right thing for you. Focus on that and see what other things you need to really consider. I think from a macro level, currencies playing out at the moment with reserve banks employing further monetary easing, second or third waves of COVID now starting to ravage the Northern Hemisphere, particularly obviously the US and the Eurozone, the UK. That's going to put pressure, I think, on currencies there as well. So I think overall, don't try and get too focused on trying to milk the last possible cent from the currency fluctuation. Think more about the real essential questions, the macros, how to perhaps structure your loan at the time to make the most out of interest rates that will be on offer at that point in time, whether to use a variable rate with an offset account or whether to use several fixed rate loans. So they're the things I think that are going to save you a lot more money and obviously make you a lot more money. And I think if you're going to make some well-informed choices about that, do your research around that piece. So don't worry about that currency fluctuation for a very small portion of your overall asset price. We're getting some more interesting questions. We've had some more about, the potential removal of stamp duty in New South Wales, and if more of our overseas expat audience has been watching, Victoria are now coming out and saying that they may follow suit in a different but similar manner. So perhaps there'll even be a situation where all of the states and territories around Australia look at abolishing stamp duty and replacing it with a broad-based type of property tax. We've had more questions about this, but I think we'll wait for another session because we want to get some more clarity about what's happening. It's still early on in the process. There's got to be a lot more public consultation and discussion for the Treasury departments in the various states to take this further, and we'll keep everyone posted as we go. So keep sending us your questions. I love them. It's really interesting. I hope you've enjoyed it, and I'll see you again next Tuesday at our Q&A then. All the very best in the meantime.